AST SpaceMobile is currently trading at $115.40, seeing a massive intraday surge of 13.98% as the market processes the implications of its newly secured prime contract position on the U.S. Missile Defense Agency SHIELD program. While the headline reflects a sudden spike in value, the reality lurking beneath this movement suggests a fundamental shift in how the defense establishment views space-based cellular broadband. Most investors have been watching this ticker as a pure play on commercial satellite connectivity for standard smartphones, essentially a way to bridge the gap for the billions of people living in dead zones. However, today's move into the Missile Defense Agency's Golden Dome strategy reveals that the Department of Defense is no longer just looking at this as a way to send text messages from the middle of the ocean. They are looking at this infrastructure as a resilient, dual-use asset for national security. This development creates a tension between the retail expectation of a slow commercial rollout and the institutional reality of a company being integrated into the core of military communications architecture. If you've been monitoring Tesla stock or Apple stock lately, you know that the market is hungry for hardware that actually changes the operational landscape, and today ASTS is proving it can play in that league. For a long time, the narrative surrounding AST SpaceMobile was centered on the technical challenge of whether a satellite could actually talk to a regular phone without any hardware modifications. The successful launch and deployment of BlueBird 6 back in December answered the technical question, but the financial question remained. Bears argued that the cash burn was too high and the revenue too distant. Today's contract award flips that script. It isn't just about the immediate dollars associated with the SHIELD program. It's about the fact that ASTS has been validated by one of the most demanding customers on the planet. When the Missile Defense Agency lists you as a prime contractor, they aren't just buying a service, they are vetting your entire technical stack and your ability to deliver under extreme conditions. The volume we are seeing today is reflective of this realization. Over 17 million shares have already changed hands, which is a significant jump from the average daily volume. We are seeing a classic short squeeze scenario playing out as well. Roughly 16.7% of the total available float was sold short heading into this week. Many traders were betting that the recent analyst downgrades from firms like B. Riley and Scotiabank would signal a top for the stock. Those analysts pointed to valuation concerns, with some setting price targets as low as $45.60. But the market is currently ignoring those spreadsheets because the reality of government integration often trumps the reality of quarterly earnings ratios in the eyes of long-term bulls. If you're using platforms like Interactive Brokers or the Robinhood app to manage your positions, you've likely seen the volatility whiplash that occurs when a high-growth name suddenly lands a government anchor. This is where the psychology of expectation versus reality becomes most intense. The expectation was that ASTS would be a wait-and-see story for the next 2 to 3 years as they slowly expanded their constellation. The reality is that they are being pulled into active programs much faster than anticipated. This creates a curiosity loop for investors who are now wondering if other government agencies will follow suit. If the Missile Defense Agency is interested, does that mean the Space Force or specialized intelligence agencies are also looking at these phased array satellites? It's a complete reevaluation of the addressable market. No longer is the upside capped by how many rural AT&T customers sign up for a $10 monthly add-on. The upside now includes massive, multi-year government contracts that often carry much higher margins and significantly more stability. We should also look at the institutional activity here. Names like Vanguard, BlackRock, and even Alphabet have been holding significant positions, and today's move likely reinforces their long-term conviction. It's interesting to compare how people approach NVIDIA stock or other high flyers. There's a tendency to look for a peak, but in the aerospace sector, momentum can last for years once the infrastructure is actually in orbit. For those using Schwab Intelligent Portfolios or other forms of online investment management, this kind of single stock volatility is exactly why people diversify. But for the self-investing crowd, this is the kind of day you live for. The ability to spot a shift in the wind before the broader market catches on is the goal. Let's take a step back and look at what the business actually does, because it's easy to get lost in the green candles. AST SpaceMobile is building a space-based cellular broadband network. Unlike Starlink, which requires a dedicated dish, the ASTS system works directly with the phone you already have in your pocket. They have over 3,800 patents and patent-pending claims, which is a massive moat. Their facilities in Texas and Florida cover about 500,000 square feet, and they've doubled their workforce to 1,800 people recently. They aren't just a paper company anymore, they are a manufacturing powerhouse. They're 95% vertically integrated, which means they control the design and production of almost every component. This is critical for government contracts because the Pentagon values a secure domestic supply chain. Past performance hasn't always been this pretty. For years, this stock was a nightmare for holders, dropping from $20 down to $2 as delays mounted and skepticism grew. The turning point came in May 2024 with the AT&T and Verizon partnerships. Since then, the trajectory has been almost vertical. In the last year alone, the stock has returned over 340%. But with that growth comes a heavy price. The company reported a significant net loss in Q3 2025, and their cash flow from operations was negative $363.4 million. They have a lot of cash on hand, roughly $1.2 billion, but at the current burn rate, they only have a few quarters of runway before they might need to raise capital again. This is the risk that every bull has to acknowledge. Even with a prime contract from the Missile Defense Agency, the bills still need to be paid in the short term. The recent move from $92 to $115 is a breakout from a period of consolidation. We saw the stock struggle to stay above $100 after the BlueBird 6 launch, mostly because investors were waiting for the next catalyst. The Scotiabank downgrade to $45.60 was a bucket of cold water that forced many retail investors to question their thesis. But the market has a way of humbling even the most respected analysts. The irrational levels of market cap mentioned by some critics look less irrational when you factor in the strategic value of the technology. If you're using investment help or looking at investing sites to figure out your next move, it's worth noting that the consensus price target of $77.25 is now far in the rearview mirror. This creates a situation where analysts are forced to either double down on their bearish views or go through a series of upgrades that will only add more fuel to the fire. I want to hear from you on this one. Comment below how many shares of ASTS you currently hold, and if you think the recent analyst downgrades were a missed opportunity to buy the dip or a valid warning about overvaluation. Dealing with these types of stocks requires a lot of discipline, especially if you're using SoFi Invest or Fidelity brokerage accounts, where the temptation to trade every minor swing is high. Looking toward the future, the catalysts are clear. We need to see the successful operation of the BlueBird satellites currently in orbit and the continued rollout of the rest of the constellation. Each successful launch is a de-risking event. The SHIELD program contract is just the beginning of the government revenue stream. If they can turn those task orders into actual revenue in the coming quarters, the cash burn concern will start to fade. The biggest risk remains execution and the potential for a capital raise that dilutes current shareholders. However, the partnership with companies like Google and AT&T suggests that if they need more capital, they have some very deep pockets in their corner. In the realm of online investing, it's rare to find a company that is essentially creating a new utility. Most tech companies are just building better versions of existing things. ASTS is building something that didn't exist before, a global, direct-to-device network that doesn't care if you're in the middle of the Sahara or the top of Everest. The dual nature of this technology, being both a consumer product and a national security asset, is the secret sauce that the market is finally starting to value correctly. Whether you use Robinhood crypto for your high-risk plays or prefer the stability of Fidelity Wealth Management, ASTS has likely found its way onto your radar this week. To wrap this up, the expectation was a speculative telecom play, but the reality is an emerging defense and infrastructure powerhouse. The contrast between the analyst downgrades earlier this week and the government contract today is a perfect example of why you have to look deeper than just the price targets. The market is rewarding the validation of the technology over the current state of the balance sheet. While the risks of dilution and technical failure are still present, the floor seems to have moved significantly higher. We are seeing a transition from a story stock to a systemic stock, and that is a shift that